Okay.
Hello, everybody, and welcome to our Online Investor Insights. We do this every 2 weeks here online. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter, and I'll put the link in the chat. And I also help founders with their pitch decks because none of them know how to do it properly. They just don't. And some investors, too, I won't mention any names. And I help them with their executive summaries as well. So I want to thank you all for being here. Today we have Glenn Argenbright from Quake and Joe Milam from Angelspan. And today, but I want to thank Joseph Katz for hosting us. Joseph, tell us about you.
Thank you, Bonnie. Thank you all for joining. My name is Joseph Katz, results-driven marketer, worked in early stage as well as corporate America, have helped companies grow from nothing to very large somethings. I like to say help companies go from unknown to well-known. So anytime anyone has any questions about marketing, feel free to reach out. I'll drop all my information in the chat, and everyone should feel free to do the same. And I know today will be a fun conversation.
Oh, I know it. So, guys, should we have everybody introduce themselves first? Our participants?
Sure.
Okay, take it. Who do we have here first? Take it away, Ian.
Hey, good morning, everybody. Ian Garmez in Toronto. I'm COO of Virtual Film School, live online training for content creation, and now also a co-op fellow with Laconia Capital.
Oh, wow. Good for you. We like Laconia. And Jerry is a force of nature. I think I've said that before, but
yeah, she is.
She really is. So, Nelson, tell us about you.
Okay, so I'm a guest of Sandra. Met her. She's an H7 member. We both network. And
I can't really hear you. Is anybody else having a problem?
Yeah.
Can you hear me now? Can you hear me now? Okay,
yes.
so I just moved the mic closer. Sorry. So I'm a guest of Sandra's, and I met her in H7, where we both network. Great group, and so I was telling, I run a PR company. I'm also in Toronto, and I work with public companies. I also work with private companies, and I'm the guy that gets out there and gets media exposure for public companies, private companies. I get them on the radio, I get them on television, I get them into newspapers, magazines, industry publications. I've worked with a lot of public companies over the last couple of years, and when I mentioned that I'm looking to talk to, angel investors or VCs, she said, "Oh, you got to come to this group." So here I am.
Oh, welcome. Oh, God, I used to do PR, but I was never Smile and Dial Girl.
Sorry, what was that? What was that?
I said I used to do PR, but I was client side. I was never Smile and Dial Girl.
Okay, so I will also put all my information in the chat, and love to have a one-on-one with everybody. Okay,
so who's that? Oh, Stephen. Welcome.
Hello, Stephen Keys. I'm from Calgary, Canada. There's a lot of Canadians here today, interestingly enough. CEO of Group KPO. We're in the project financing business. So projects looking for capital, matching them with investors looking for opportunities. And we also manage the execution of projects once they're financed.
Thank you. Abigail.
Morning. Sorry, I'm commuting, so I'm just listening without video.
No
worries. We doing intros or sorry?
Yes, just tell us who you are, what you're working on, briefly.
So I'm a fractional COO for early stage companies. So I get involved and help plug leadership gaps, and just interested in hearing perspectives on what people are building right now, and just getting familiar with the space.
Oh, well, welcome, Andrea. Oh, you're muted right now. Maybe she can't talk. Annie.
Hi, morning, everyone. I'm Annie, and I am the owner of a influencer media agency. And we basically be the matchmaker between the brand and the creator side. So I'm willing to have a cup of coffee if you would like to talk more about it. Thank you.
Oh, I'm always up for coffee. Deborah, welcome.
Hi, everyone. I'm Deborah Lee. I'm co-founder of Debonair Consulting, work with Bonnie, and we help prepare founders for investments. So we help them with their investor materials, as well as coach them on presentation pitches, and if they would need and would like, we introduce them to investors.
And strategics.
Yes.
Joseph.
Joseph Thibault, had the pleasure of working with Joseph Katz early in my career. So thank you for the invite. On a project right now, EdTech space for authorship verification called Cursive. And how you type is a unique biometric identifier applied to education, solves AI writing in the classroom, solves essay mail usage and those type of things. So a little bit of a academic integrity play in addition to surfacing a lot more learning analytics.
Thank you. Ken Deering.
You're on mute, Ken.
Oh, you're on mute.
Good morning. I'm Ken Deering, CEO of iGuard Home Solutions, calling in from Seattle. Another Canadian expat to the group here. We are, and I'll just run through this. Delighted clients of Debbie, Bonnie, and Angelspan. And we have an age tech solution, so we permit older adults to safely continue cooking when impacted by cognitive memory issues. It's important, 30% of Americans by age 60. No one in this group is impacted by cognitive memory issues, primarily from prescription drugs. And also, we have a important predict and prevent InsurTech solution for property and casualty and long-term care solutions, but they also have a problem with what we solve, which is forgotten cooking fires, which is the #1 cause of all housing fires.
Thank you. Kirsten.
Good morning, everybody. Yes, I am a co-founder of the Regener Studio and Olazoi, two companies that are in the regenerative living space and regenerative community building space. So in the Regener Studio, we are offering an accelerator where we are bringing community builders who have no clue on the business side, make them investment ready. So we take them through a program. And on the other side, we are training impact investors to actually think regeneratively so that we can make regenerative living the norm and not the exception. And I'm also a leadership and mentor, leadership coach and mentor for visionary change agents. So.
Thank you. Mark Weissman.
Morning, Mark Weissman, Managing Director of Navidar. We are an Austin-based investment bank focused on working with technology companies, primarily doing sell-side M&A and growth stage capital raising. I'm based in Cleveland and love coming to these events, and I will put my LinkedIn information in the chat.
Thank you. Meg. You're muted, Meg. I don't know if you want to introduce yourself. Oh, maybe not. Sally.
Hey, good morning. I'm also traveling, so no video for me, but my name is Sally Ricker, and I am the founder of the Project-Based Learning Company. And my goal is basically to kind of overhaul higher education and change their degrees, put some real world learning into every degree program. And I am looking for investors, and I'm on my way to pitch right now to a university president.
Oh, good
luck.
Good luck to you.
Thank you.
Sandra.
Good morning, all. I am Sandra Connor, the creative force behind and owner of videogrows.com, where we provide visually stunning media for your storytelling that sells. Whether it's to buyers or investors, we get the motion media out there so that your story is clear and gets the results you want and need. Sandra Connor.
Who else? Tony G.
Yeah, hi. I came a bit late. Yeah, my name's Tony. I'm currently going through some severe changes in terms of what I'll be doing in a couple of months. I'll be off doing some natural building projects with my hands for money in Central Europe. So I'm definitely going pro with that. I'm also about to start a water retention 6-month program with a bunch of guys that are around, across the globe, and they're doing the permaculture type of dams and water retention systems, on a course which is designed for that, because it's not really being done properly everywhere. Before that, so I'm going into that well deeply. Before that, I've been a finance professional for a couple of decades, and before that, I was a earth scientist, geologist, geophysicist in Australia.
Thank you.
So yeah, I'm going through a massive change.
Well, good luck with it. You'll be fine. Michael Duke.
Thank you. We're making sustainable, technologically advanced flight affordable, safe, and quiet. The aviation sector is one of the most difficult to decarbonize.
Recorded. Oh,
pardon me?
Oh, that wasn't me. That somebody, I didn't mute that.
Sorry. The aviation sector is one of the most difficult to decarbonize, and we have a very efficient design, which will reduce carbon and also noise. And so we are raising a small amount via convertible note or SAFE. So looking forward to learning more about convertible notes today, and bringing on some new team members that have some world-class experience to help us accelerate our growth.
Oh, thank you. Puck.
Hi, Bonnie. Hi, everyone. I'm Puck Fernston. And at the moment, I'm a trader of big bullion deals and jet fuel and all that kind of fun stuff. And also an advisor for the NEOM project and NEOM Autonomous that I want to make sure that Bonnie knows about and our friend Joe knows about, so we can get some of the best startups in New York and around this country and Texas funded, because there's lots of money out there as the Saudis are trying to diversify their economy. And so we're working with the leaders in these communities to get their businesses funded.
I'll leave to talk. Scott Purdy. I didn't forget you, Scott. Oh, you're muted though. Oh, maybe he's multitasking.
He's having some issues today, Bonnie. He tried to join a few times.
So, Joe and Glenn, take it away. Do you want to briefly introduce yourself first, and then we'll talk about convertible notes? And
sure. I'll go ahead, Joe. Just get it out of the way. Real quick, Abigail, send me your info. We're always looking for fractional COOs and CFOs. We've got about 280 teams in the portfolio. Same for you, Mark. We're at a maturity level where we've been doing a lot of work with investment banking. I like kind of the regional aspect of your conversation there. And then Joseph with the biometrics. I ran one of the biggest public biometric companies back in the mid 2000s. Would be happy to talk to you about, my experience there, and just if I could be helpful, some of the relationships we had. So just taking off the top, just some of the things that came there. My background, I started in tech in the mid 90s in Silicon Valley, got very lucky. Ended up launching a large public ad tech company, and ended up going public with Lehman, for those of you old enough to remember who Lehman is. Did really well with that. Ended up doing about 13 more startups that I launched or restructured, exited 8 more, took 2 more public, formed a family office in late 90s, early 2000s, did that for a while, did about 100. I've always loved early stage. I think it's what moves humanity forward. So innovation is anyway. So I did about 110 direct investments of my own in early stage companies, and then launched Quake about 7 years ago. I'm more of I guess you'd call me a chairman now at Quake more than anything else. I'm not really involved as much with the direct investment committee. For new investments, I focus primarily on our existing portfolio, which is about 280 deals. We're going to talk a little bit today about zombie funds. There's going to be some interesting stuff there, which I'll get into about how we've had to evolve because of some of the things happening in the industry. I'm sure Joe will talk about that as well. And then the other thing that might be interesting, just based on some of the conversations from the crew here, I'm a partner on an impact fund out of Dubai. It's about a $50 to $100 million fund. We just started raising 3 weeks ago. We raised 12 in the last 2 weeks. So pretty confident we'll get to our 50 to 100 million mark on that one. And then I'm working with an A round fund out of New York as well. And we're in the process. We've got 10 of a $30 million to $50 million round already closed as well. And we started about the same time. So I'm pretty busy, but I'm focused mostly on our existing portfolio here at Quake. That probably takes most of my day.
Joe Milam. A lot of familiar faces on this call, so it's not a stranger. I ran a multifamily office for 20 years. I got the great fortune of joining a firm in 1990 that's right there at 3000 Sand Hill Road in Menlo Park, the epicenter, or the former epicenter of the venture world. First portfolio I was handed to manage was Larry Cincini's personal money. And then there was other distinguished clients, Sequoia Partners, Silicon Valley Bank senior executives that were all clients of the firm because of who my boss and predecessor was. He was old San Francisco money and had been in the investment business since the mid-60s, started his own firm in 1970, and was contacted by a European bank that wanted to establish a foothold in Silicon Valley, and his firm was recognized as the most prestigious sort of boutique firm in the Bay Area. And so he sold his firm to the bank in Liechtenstein in 88. I joined in 90. He died of cancer in 92. I took over the business and bought it back from the bank in 93. And a year later, the internet commercializes and all hell breaks loose right under my nose in the world of venture and angel investing. And I just had a front row seat because of who the clients were and where I was and when I was there. I mean, as I like to say, I had a series of Forrest Gump-like experiences that shit just happened right in front of me. Because of the Band of Angels, many of you may be familiar with, that was founded in my office by my subtenant, Hans Severns, who was dating my client, Francesca Gardner, and wanted to see how this young Turk was running her money, and we were very good from a performance and process standpoint. So he wanted to see this young kid I was 31 when I took over the business. And he saw I had an empty office there at 3000 Sand Hill, and he asked if he could use our conference room and take up part-time residence. And that's how things evolved. That became the Band of Angels, which, by the way, was just a dinner club. It wasn't an organization that was trying to invest in startups and rally all these purported business executives and business angels. It was a social club. And it started out having dinner once a month at Chantilly's in Palo Alto. And one of the guys that was a attendee said, "Hey, there's this new thing called the internet. And I got a buddy that's starting a company, and he's got room on his term sheet. Anybody else interested?" And they said, "Yeah, have him come back at next month's dinner." And that's literally how the Modern Era of Angel Groups was formed, was by accident. So anyway, that led, I got active in angel investing after I took over the company. And the clients were asking me to see, hey, if there's things you see that we might like, let us know about it. And this was a precursor to what we would call impact investing today. Our clients were old money, as was my boss and predecessor, with names like DuPont and the families that founded Westvaco and a whole lot of other old money, old corporate interest families. And then there was the new crop of new money folks that were from Silicon Valley there that had the new money popping up in the late 80s and early 90s. And so as I started getting more active, I was an early member of the Band of Angels. There was an angel group that formed out of eBay, where we were seeing 3 deals every 2 weeks in the evening time, because they had already been vetted by eBay's venture committee and traveled to pitch the venture committee during the day. And one of those committee members said, "Hey, why don't you stay around? We've got an angel group, angels getting together, and why don't you just take a look at, stay around and pitch to some individuals right there at eBay's headquarters." And I was the second non-eBay employee, the 9th member of that group that became about 120 strong, seeing 3 deals every 2 weeks at eBay's headquarters. So again, I just had these experiences that put me in the front of the modern era. but from the lens and from the perspective of a professional money manager. We did our own securities research. We didn't talk to management. We didn't talk to Wall Street analysts. We actually did the data analysis through external data sources, built portfolios, and managed money. And that was where that was through that lens that I've been examining the venture funding process and have been on a quest now of 24 years. April 1st will be the 24th year that I've been trying to bring the sort of tools and professional investment tactics that we deployed organically and managing money in the public markets to build out those tools and tactics to bring a level of professional investment rigor to the early stage venture investing. So that's my background, Bonnie. We'll kick it to you for moderation.
Muted, Bonnie.
I was going to say, let's talk convertible notes.
Convertible notes or safes, huh?
Whichever. Does everybody want to hear about convertible notes or safes?
Oh, well, it's important distinction for this conversation because you want to talk about Nevada. So, I'll go ahead and kick this off.
We don't have to restrict it to Nevada because.
No, but I'll start there just because you'd sent a note around about this new suit that happened in Nevada and a ruling that came out of the state. So for those that aren't familiar, the court basically came in and said that specific to convertible notes, we'll talk about the distinction with safes in a minute. Oh, and I should preface this, I'm a lawyer, but I'm not your lawyer. So I'm not providing any legal advice here. I would definitely recommend if you guys are working on anything related to convertible notes, safes, whatever, you talk to your counsel. But I'm just going to give you my take as somebody in the industry looking at this particular case and this case law that's evolving. So the Nevada court basically came out and said that the right to convert on a convertible note expired at the time that the maturity date on the note expired as well. So they basically said that you had to, what that effectively does is the investor in that scenario would have to convert their convertible note into equity prior to the maturation date, or they would effectively lose that right. Now, it's important to understand that that is specific. I think a lot of people interchange the terms convertible note and safe, and a safe is a convertible type of instrument, but it's not debt on your balance sheet, and it is distinctly different from a convertible note in that it does not have a maturity date, which is hugely important in this particular instance, and it doesn't typically have interest. Now, I say that because a lot of founders monkey with safe notes, and they add a lot of terms and make changes to these notes, and I don't generally advise that you do that for the reasons that this case really illustrates. You could very easily modify a safe note in a way that would run afoul of this state rulings, because again, you could add a maturity date or do any number of things. Just because you have the word safe at the top of the note does not actually mean it operates as a normal safe instrument would. It would effectively sit as debt on your balance sheet and run afoul of this law. So when you're looking at this case law out of Nevada, this case, I should say, it hasn't gone to appeal yet. Okay, it's in the process, but it's going to stir up a lot of controversy on appeal. It's one state, so it's not, this isn't the law of the land right now. It's pretty easy to get around, even in a convertible note. All you would really need to do if you're an investor, or even for that matter, a founder who wants to provide security, your investors are upset about it or worried about it. All you need to do is extend the date of, use explicit language and extend the date of conversion either well into the future or until the obligation is resolved. Okay, so until the money is paid back or the note is converted, you continue the right. So you could do either of those two things, and you should be able to get around the law as it's being interpreted right now. The second thing is use a standard safe note. I know there's a lot of people who love them or hate them or whatever. I don't really have an opinion one way or the other about these instruments. I mean, I suppose I do in the abstract, but they all have their place. But a safe note, if you use that in this particular instance, would not run afoul of that law. Okay, so hopefully that's a clear distinction between the two. Again, a safe note does not have a maturity date. It doesn't carry interest. typically. And again, if you're monkeying with the original construct of a safe note, it's really not at that point. You do so at your own peril, is what I would say. Why do we use, real quick, I'll just say this. I mean, I don't want to be, too pedantic here, but why do we use convertible notes? Because we're lazy, to be blunt. Convertible notes and safe notes are because, and I don't want to lump Joe into my category here, but VCs are lazy. We don't want to get into arguments around valuation. It's kind of a fruitless argument in many cases. Joe and I are data oriented, so we could probably have that conversation easier than most people, or maybe harder for the founder than most people. But generally, VCs don't want to get into a dispute about valuation. So the safe note or a convertible note allows us to put off that negotiation until effectively your next round. In the case of a safe note, it converts in the next round almost always. It sometimes has a trigger related to the amount. In the case of a convertible note, not so much necessarily the next round, more about timing, but either one of them puts the debate off for 6 months to 6 years until that valuation is a little easier to determine. So that's the main reason why people do it. They're quick, they're understood. The founders don't seem to push back. The VCs, and not so much the VCs, but their co-investors don't really push back either. So it creates an ecosystem match. That's why we do it. But I don't think, Bonnie, long and short, in my 7-minute spiel here, long and short is I don't think that this ruling is going to have any particular impact on the industry in any meaningful way, even if it was to take foot in other states, which I don't think it will, frankly.
There's so much craziness going on in the industry right now. Anyway.
Yeah, there's enough for us to worry about. This one, I really do hope they don't. Well, I don't think this protects anyone. I don't think this is designed. I don't think this is a situation where investors or founders are in particular need of protection from the terms of the document. So I think this is a case where I'd rather the court stayed out of it, to be blunt.
Joe, anything to add? Or if anybody has a question, but first you, Joe.
Yeah, we're not going to have. I don't think Glenn and I would argue over anything, quite frankly, or any subject matter. He's correct on all fronts, as you might expect. The only thing I would reinforce is this issue of calling it a note from a legal standpoint is incorrect. The current iteration of the safe instrument, Glenn was using note or instrument. An instrument is the proper language because the Y Combinator template changed in about 2018 from an actual note to a safe equity instrument. And that's the proper language. And so if you have raised money on a safe instrument or safe document that might have been prior to 2018, you might have an old note on there, the old Y Combinator template. But they did change it in 2018, principally to accommodate for some the QSBS tax laws.
That's right.
To make sure that they were capturing the benefits of both 1244 and 1202. And we can go down that rat hole if you'd like. But these are really, really important tax incentives for both entrepreneurs and investors that have been largely overlooked by the investment community for decades and is just starting to get some proper attention. And even Y Combinator's fancy lawyer that loves to pat herself on the back for inventing the safe instrument with a safe note didn't even know about the QSBS laws. Otherwise, she would have not screwed a whole generation of investors in the form of that terms of the original safe note that Y Combinator had promoted. So these are editorial comments, but it's a fact. And it just points to the larger issue that we can get to, which is what is sort of the drum I keep beating all the time is the real lack of professional expertise amongst 90% of the people that call themselves VCs or even the advisors to entrepreneurs. There's a lot of lawyers and accountants that claim to have an expertise and are focusing on startups. And I've just seen bad advice from very large branded law firms and accounting firms, because oftentimes it's the junior partner or the junior accountant or lawyer that's sent out in the world of startups mainly as a role of biz dev versus actual knowing what the hell they're talking about. That's just an editorial comment.
Joe, you
Glenn?
mentioned one thing that's important to bring up though, that I failed to mention, which is if you're an investor right now and you've got existing notes, what'll often happen is that when they come close to maturity, the founders will reach out to you and say, hey, what do you want to do about these notes? Because they don't want to have to pay. And so you're in a particularly interesting position in that case. I would go ahead and do an amendment to the language to add in and work with your counsel to add in language extending the conversion right, explicitly. So I would do that if I had a note that's coming up for maturity and you've got a good relationship with the founder. And then obviously notes that you're entering into now, I would draft language accordingly. If you don't have the ability to change the note, again, I think the risk is very nominal here, but there is a risk that this could take foot and impact existing convertible notes.
Yeah, the current safe template doesn't have a termination date. That's a big key component of taking it from a debt instrument to an equity instrument, which is what QSP requires. So they eliminate the terminal nature of there's not a date certain, it has to be repaid. That's a structural component of a debt instrument. So anyway, but
you'll see, but to that point, Joe, you'll see founders take the old note, add that language to the new safe instrument, which completely nullifies that characteristic. So just I guess the recommendation for founders is be very careful with monkey. I mean, I don't want to overthink it, but some of these are pretty commonsensical, but there are certain elements in these documents that are designed the way they are for a reason.
Yes, and that's the other point I wanted to touch on, Glenn, is the reason, as Glenn pointed out, that these were formed was to streamline the velocity of investing. Okay, to get rid of what's called friction costs, things that need to be negotiated or haggled over, valuation being the biggest one. Most people in the venture world don't know how to do valuation, and that's 9% of the VCs that invest early stage. And so they defer it to folks that have more experience and more confidence in the form of this safe note. But the value of having a template, which again, I would completely concur with Glenn, is that you don't want to monkey with it because the standardization process is for yours and the investor's benefit. If you just look at basic market theory, and forgive me if I get a little bit too professorial, but I lived in this world for 20 some years studying efficient markets and how to find information advantages and all those sorts of things. And the velocity of investing accelerates when you use standardization. So you start monkeying with it, you're literally shooting yourself in the foot and probably do something that does damage to you and or the investors at the same time, just by haggling. And if an investor is trying to get in there and monkey because they've got to feel like they negotiated hard, which is something you also see all the time, that's where you can push back as an entrepreneur, say no, or do it in a more delicate way that I probably wouldn't say, well, why is that important to you?
Yeah, it's sort of an EQ IQ test, right? Yeah, I mean, you're learning something about them at the same time.
Yeah. So that's another thing to keep in mind, is that there's value in the simplicity. It's you sacrifice applicability to unique circumstances, but early stage, you're trying to get money in. That's where the safe is used. You're trying to get some early money in and defer a lot of the difficult conversations until see if you can get some traction with that early money. And that's the functional role of a safe instrument. And in its current form, it qualifies for QSBS. It keeps it simple. It doesn't have a termination date where this Nevada law that I think Glenn is spot on. It's going to take a long time and probably not ever be that relevant for most investors and or entrepreneurs if it ever does get any teeth and survives challenges. But at the end of the day, I wouldn't overthink the safe notes. I'm a fan of just going in and doing a priced round. I think it's an important conversation to start, both for the entrepreneurs, but also it'll give you a litmus test on which of your investors actually are thoughtful investors versus just drive-by angels that are sprinkling money and wanting to do it and move on and not give much thought to it. So anyway, that's just another editorial comment.
Does anybody have a question? Feel free to ask.
Yeah, jump in here. I get tired of hearing my own voice.
My question is, what is a good book for us to get fully up to speed on these instruments? I like books.
I'm trying to remember the
Yeah.
name. What's Feld's book's pretty good.
Yeah.
Doggone,
Got
what's
that.
the name of that? Yeah, that's
Venture
a good
Deals.
one. Yeah, it's a good book.
Okay.
It's a little dated. But the underlying, the basic theory, and again, I used a nonsensical word saying commonsensical, but basically the common sense does play a pretty big role in law, right? Common law, effectively, right? And the Uniform Commercial Code is very common sense oriented as well. So what you end up finding is that even though that's a little bit of a dated book, it was well thought out. Again, Joe and I might not agree with every VC has a very specific way of approaching their business. And like, for example, taking Y Combinator for a minute on the safe note, they won't deviate from their instrument, right? There are other VCs, I can't name them all, we're one of them, where we don't really care about the instrument. Like, we're going to analyze the deal, we're going to analyze the instrument. We're usually participating with other investors, even though we're, oftentimes a first institutional check, we're still coming in as part of a syndicate in many cases. So we kind of we've worked with KISS notes, convertible notes, safe notes, equity deals. We really analyze the deal individually, but most VCs won't do that, to be blunt. So I think anytime you read a book by any particular VC, they're going to have their flavor, right? And Brad certainly has that, but I think he's got a really good common sense approach to how to interact with the document, how to deal with the VC. I actually think that's one of the better books that's been written.
Yeah, that's actually the textbook that we're using in the co-op program at Laconia right now. So.
Oh, well, and I forgot you're in Laconia. Laconia is a great team, by the way. Yeah,
thank you. Yeah.
One quick comment, Bonnie, on convertible notes that has nothing to do with structure, just some interesting facts, because there's some things changing.
Sure.
And again, my background's data science, so I tend to follow I get geeked out on the data. So we saw, everybody's talking about like valuations were taking a hit, but the second half of last year, we started seeing valuations after 3 consecutive down quarters. We saw them go up in the second half, and they've continued to go up since then. But we're also seeing some other really interesting things I pulled before this. I was looking at a report from Omni Analytics. I don't know if you guys, it's a service that a lot of funds use. But interest rates have gone up dramatically on convertible notes, which is, not really that big of a surprise, but we're talking about the median rate at the end of 23 was 10%. That's about a third higher than it was the prior year. The more really stunning thing to me was discount rates. Discount rates, for those that, that's the discount to the future. So you set the valuation now, and then you basically say, but with a discount to whatever the next round is, I'm going to get the better price, either the valuation I set today or the discount against your future round. So if I have a 20% discount, you got a $10 million future valuation, that's an $8 million deal. If that's better than the valuation I set today, I get that deal, right? So the discount rates on these notes have historically been 20%, is pretty much like jam spot the norm, right? But the number of deals, so that historically has been about 15% of the deals have been over 20%. In 2023, that moved to 23%. It's already moving up this year. So we could see 25% of the deals this year that are over 20% discount rates. And what's stunning to me is we're now moving into the 5% territory for deals that are over, and I don't even know who does these deals, 50% discount rates. As an investor, I wouldn't do that deal, because I can tell from the structure that's a distressed, like crazy, ridiculously crappy deal. And it's a founder IQ question. Like, you got to know when to quit, how to restructure, do something different. That is that's almost like a death spiral deal at that point. So anyways, we're starting to see these crazy numbers ticking up, Bonnie. They're moving back the other direction faster than I think most people realize in a really kind of a rough economy, but these numbers are starting to move the other direction. Obviously, it's a buyer's market on discount and interest, but we're seeing the valuations move up is what I'm trying to say.
Retail's paying a higher price, and then the folks with sharp elbows are getting their lower price through the structure, through this discounting mechanism.
That's exactly right, Joe.
Yeah.
Anybody else have a question?
Yeah, I do, but I can't see where to raise my hand for some reason.
Oh,
Anyway.
you can just give us your question.
So just jumping in. So I've heard that there is more dry powder than there ever has been, but I'm not sure that, where that is coming from. And I've also heard that the seed and Series A deals are starting to flow more freely than later rounds. But again, I'd love some insights on. I'm basically in a Series A position. That's our next round. So I'd love to really understand what's happening in those earlier stages, and really, is there, how well are the funds starting to flow again?
Yeah, that's a good segue because I know that's what's on the agenda.
Yep.
Lot to cover there. Joe, I don't know if you want to go in. I do want to dig back when we get to it. I do want to dig back on there is definitely an uptick on pre-seed, seed, I would say early A relative to late rounds. We can talk about that, but this is a big topic. Joe, you want to kick it or do you want me to do it? How do you want to attack it?
Yeah, you go ahead. I'm going to counterpunch on this one because you probably have more statistical exposure. I've got a little bit more elevated observation, but you probably see more activities with real data than mine through observation. Go ahead.
Yeah, so this is where I'm a reluctant venture capitalist is kind of the joke, right? This is where I get pissed with my industry a little bit. The last year has been really, really frustrating. We were, before everybody joined, we were talking a little bit, Bonnie wrote her note about zombie funds. We're talking a little bit on the off about zombie funds. That's a real thing. Like, I mean, and we're in, even though we're seeing an uptick in capital deployment around early stage deals, there's some estimates that about 23 to 25% of first early stage funds that raise their first fund trying to move to their second have failed and gone away. A quarter of that orbit may have disappeared. Now that's not my number. I think if I'm recalling correctly, that's PitchBook. It's either PitchBook or CrunchBase.
It was PitchBook.
And that's just a stunning number, folks. And then the later stage folks, the reason that's pissing me off and as a VC is that they're putting out all the signals that they're still open for business and they're talking a good game. We've got really good PR firms working in VC, trust me. So they're getting good stories out there about dry powder, like Michael was asking. There's a lot of good stuff out there, but that powder in the later stage companies is largely reserved for their distressed, later stage, bloated, really expensive burn rate deals, where they're having trouble raising later rounds. These companies have long ago stopped being generalists. They're specialists. What do I mean by that? So a lot of operators here on this call, when you're starting out and you have 4 or 5 people, they do a lot of different things really well. You end up figuring out, or you hire people who can do multiple things. As you evolve and you break about 22, 23, 24 people, anybody who's run a company sees this, you start hiring specialists, probably even a little before that. Those people are great until things slow down. Because when things slow down, you start laying them off, the people around them have no idea how to pick up the slack. So it actually is an accelerated deceleration when things go the wrong direction. And so you see these companies that have these big bloated payrolls that start having a slowdown, that don't have people that can pick up that slack. So they have trouble cutting staff effectively and keeping momentum rolling. And so these companies struggle to raise capital. They have to go back to their existing stacks of capital. That becomes limited very quickly, no matter how big they are. I'm not trying to pick on anybody, but even if you're an Andreessen or a Sequoia, there's only so many of those deals you can do. And what you effectively see is that they slow their roll in all new business, which for people like me, we're not, we're still deploying capital, but now we're having to do a lot more of that kind of work as well, because our deals, which are going upstream from pre-seed, seed A into B, can no longer get capital from the existing sources for B rounds. So This is a trickle down problem. I'm not trying to put it all on them. I'm just saying that each successive group makes it harder for the next group to pass along their deals, so that we're all having to put more capital into our existing. So even if you're not a zombie, you're acting a little bit like one right now, probably, because you're having to shore up your, the best deals in your portfolio. Yes, there's a ton of dry powder, Michael, but it's a really deceptive number, man. I would say you're in really good shape. Being pre-seed, seed, or A is definitely a lot better right now than being in a B. But here's the negative. What's happening to all those B round companies that can't get money from their existing sugar daddies? Okay. They're going downstream. So now your B companies are competing against A. Your A are competing against seed. Your seed are competing. Well, all that's kind of muddled, but you can see what I'm saying. You're coming downstream. So the competition just got harder as well. The deals got better. And I often talk, and I know Joe works with a lot of families too. We've just got a lot of those relationships going back to years. And it's funny, I have these conversations and you have to wonder why you're seeing, like, families don't generally get, Joe, again, in Sandhill, he was in a completely unusual space. But if you take most families in the middle of the country, they're not getting the best deal. They're not seeing the best stuff on the planet necessarily. And they need to ask themselves how this deal got on their desk. And right now, that's not as much. There's so many really good deals going to VCs that a lot of the other deals are being pushed into these kind of oddball meetings that they wouldn't necessarily have had to take 2 years ago or 3 years ago. So I think, Michael, it's a mixed bag. I don't want to sound like I'm negative, but I guess I'm a little bit negative. I think we need for the later stage companies, and they have the dry powder. I think the bigger issue is they're not willing to take on the risk in the economic environment right now. That plus, and Joe, you can weigh in on this. I think the other thing that we're seeing, you and I talked about this before, kind of like we saw tourist investors before, now we're seeing these hot pick investors, AI, for example, right? So there's a lot of industries that are overweighted right now. Well, not a lot. There's a few industries that are overweighted right now dramatically. You could throw a dart and hit a crappy company that raised money. I just saw another, who the hell is investing in scooter company? Sorry if anybody knows what, but I just saw another one just raised a whole ton of money just yesterday. How many scooter companies do we need? I mean, I'm not saying that's a trend, but I'm saying there's just some really bad discipline in the market in general. And as a result of that, coupled with risk aversion in the current economic, environment, these later stage funds that do have dry powder are not deploying. And if they are deploying, they're only really deploying it cosmetically into their existing deals. Maybe they're doing 1 or 2 deals so they can keep the appearance that they're doing public stuff, and they announce the hell out of it. But there's just not a lot happening at that level right now, which is putting a lot of stress on the rest of us.
Yeah, look, again, Glenn's observations, I think, are spot on. I couldn't have said it better. I would have taken a lot more time to articulate what he articulated so well. I always take a lens from a little bit 10,000 foot and say, why is this the case? Well, this is the third cycle I've observed and studied in the venture world, and it's the same damn behavior. And the entrepreneurs are the unfortunate victims of an industry that literally is structured, or it's has become incentivized to pursue these boom and bust cycles and go through and this last round of just an explosion of new funds, because the Cartas of the world and some of the other companies that has made fund administration so cost effective through the cloud and creating software around fund administration, you had this explosion of venture funds. And yes, the industry needs to go through this. And as any disruption cycle that actually is a healing process.
Yeah.
And an evolutionary improvement in a system, you need to go through these cycles. but you also need to be more intentional in what comes out on the other side. Use a little design thinking and saying, what can we learn from history so we don't repeat history? As particularly the bad behavior that leads to bad outcomes, which we're in the deep middle of right now. We've just had these cycles that keep repeating themselves because of the industry itself. Now, I'm fingers crossed the venture industry, I hope, is going through a meaningful disruption cycle. I believe it is. Having studied it for a long time, the narrative has changed dramatically enough. There's enough people and enough studies and observations to say we can't keep doing this. That's the definition of insanity. Right? Keep going through the same boom and bust cycles, having these same contractions like we're experiencing now. The entrepreneurs are the heroes in the system. The VCs have been, with their witting accomplices of the media and the CrunchBases and the tech crunches of the world, position the investor as the hero in entrepreneurial capitalism, which is just not the case. And so there needs to be a professionalization of the investment process, so that we mitigate these boom and bust cycles and decisions are made in a more, let's just say, thoughtful and rational investment psychology. Again, it's not like we're going to eliminate the boom and bust cycles or the human beings' natural instincts to get caught up in FOMO. It happens in the public markets, right? So it's not like long-term professional investors aren't subject to the same things. But that doesn't mean you should just throw up your hands and say, yeah, this is just the way it is. And that's what needs to be fixed. So I know that's my editorial comment, but it's just spot on.
And Michael, one quick comment. I used to tell my management teams, don't bring me a problem without a solution. And I didn't give you much of a solution. Let me give you a quick comment of what I would do if I were in your shoes with these teams coming. I've said this on other calls, so apologies if some of you have heard of this. But if I encountered a team that was coming down from an A round into my seed or a B round into my A, that's a broken team. And I'm gonna separate myself from that team by their inability to execute previously, and by their known, we know what their potential is. It's already been on full display. They hit a wall and they've come back the other direction. Your potential is unknown at this point, let's say untapped or whatever. It's got much higher threshold than somebody who's already broken. So even though you do have a risk component because you're earlier, that's the attack vector I would take if I were in your shoes and I was encountering, pushback. Because I've seen this. I've been on calls with multiple VCs and they're talking about some other more mature deal. And, I tend to be the operator guy. So I'm thinking, well, that's a piece of crap. It was already broken. But that's how I would, if I'm the founder sitting in front of that group of VCs, probably how I would address that situation. Just know that they're looking at even if they're not talking about those deals, do know that they're looking at deals that they may perceive as a good value because they were previously 25, now 15. 25 million now come down to 15 or something. They may perceive that, and just know that that's happening. You kind of have to know the subtext of what's going on in these conversations that are outside of your hearing.
Thank you. And if I may, that actually leads into my next kind of question, which is there's a lot of optics around emotions, and that defines then how we think about a problem. So I've seen, in fact, I just saw one yesterday. I was looking through PitchBook at some competitors, and it listed this one investment round as a triple A, as opposed to moving on to a B or a C round. We're at a point, and particularly, as a hardware company, we don't seem to fit the metrics of, okay, when you move to a B round or you're at an A round, you need to be having a certain amount of recurring revenue and so many customers and all these things. I mean, we're a lot more like a medical device company because of the certification. We can't go out and do a lot of sales, they're pre-sales. You can't actually deliver products because it takes 3 to 5 years to go through FAA certification. And yet, there's milestones along the way. So, how do you define yourself in hardware? Are you an A? Are you a seed? Are you a pre-seed? when do you say, okay, I've moved forward, or do you continue to say, oh, we're still in our pre-seed round, we're still in our seed round? I mean, how many times can you say I'm in a seed round or I'm in an A round, and not kind of mess up the optics?
Yeah, that's a great question. It's fascinating to me how many different definitions there must be. It doesn't mean anything anymore when somebody says it's an A, it's a B, it's a C.
Right.
So
it's arbitrary. Yes, Michael's a client of ours of Angelspan, and he's heard and seen our materials and the reporting in our investor relations service is built around what's called the Bell Mason diagnostic. And this is a scientifically designed and architected and back-tested framework on the entrepreneurial journey and what to do and when to do it. It's what the EOS, the Entrepreneur's Operating System, is extracted from. It's what the Lean Startup Canvas is extracted from. It's all from the Bell Mason diagnostic. That's sort of the trunk of the family tree of entrepreneurial execution playbooks. And it clearly defines the stage of a company based on what you've accomplished, not some arbitrary funding round label. People say I'm a seed stage company. What the hell does that mean? Well, the Bell Mason provides that standardized construct to define seed stage. Now, Bell Mason's been around for 30 plus years. It originally was released. Gordon Bell wrote the first book on how to start a startup. And he's the principal architect with Heidi Mason and Coopers and Lybrand, the accounting firm, because they even recognize that GAAP accounting is an insufficient reporting construct for the early stages of the startup journey, where you're just basically spending money and building what accountants would effectively label as balance sheet assets. And oftentimes it's intangible assets, but it's still the right things to be doing before you could ever monetize these balance sheet assets you're building. But how do you capture them and report externally? The stage of the business, what's a logical framework of your stage, and so you can label your funding round appropriately. But secondarily, what value have you created in the construct of the business? Much like, Michael, what you're building is very similar. And as you probably know, we've got a lot of biotech companies that are clients of Angelspan. And the Bell Mason and reporting for them allows us to communicate what they've built, and equally as important, the velocity of their effectiveness of hitting these operational milestones. Now we can start putting tangible data to what good management looks like through the velocity of their execution, the ability to execute against a proper, rigorous framework. Now, this is, again, the old guard of VCs have known about the Bell Mason diagnostic for decades and have used it. The NEAs and the IVPs, the old guard VC firms, used it as their due diligence framework, and they expect to be reported to from their portfolio companies through this framework. Corporate VCs have used it for decades as their construct. That's where the Bell Mason group took it as a consulting practice to corporate VCs. They've created. Heidi Mason was a consultant. Gordon had retired from the Bell. But point being, it's been used by the serious fiduciary investors for decades. But when we have this lack of professional standards, this lack of any barrier to entry of anybody calling themselves a VC, they all want to recreate a wheel that's long since been identified and framed, because they've got to purport to have their own secret sauce or information advantage or edge that they like to claim they have by launching their first venture fund. And like I said, I've just watched this play out for decades now. And when these are all, it's sand in the gears of entrepreneurial capitalism. Lack of the safe instrument in its current form has become a very decent instrument to get rid of the friction of getting transactions done once buyers and sellers have come together, investors and entrepreneurs. That's good news. It's got its own flaws, but that is good news. And for early stage funding rounds, whatever their label, it's terribly appropriate, because you don't need to overthink valuation. Investment results are binary. They're either going to fail or they're going to give you some asymmetric return. Haggling over valuation in the earliest rounds is a dead end. And it's a tell on an investor that really isn't that experienced in the asset class. Because when you're wasting that much time on haggling on valuation in the early rounds, when you should be thinking in terms of managing portfolio risk and constructing the portfolio properly, that's where you're going to manage risk better. So I'm on a rant here, but this is really triggering this notion of arbitrary labels. And
there's no Merriam-Webster for our industry. I mean, you mentioned that the old guard does, but unfortunately, that's become, you got the Merriam-Webster, kind of the common folklore or urban dictionary. We kind of got all these different definitions now. What I would say as a guide to entrepreneurs, again, going back to you, Michael, I would say, if I'm going in to talk to a fund, I'm not going to say, I'm not going to categorize myself, or I'm not going to go to the fund and say, what round do you invest? Because all these funds, most funds usually have a charter. I mean, Bessemer will write 25,000 to 25 million, but most funds have a very specific charter they target, both in terms of industry, valuation, stage, etc. I wouldn't necessarily go in and say, do you guys do A, or I'm A, or any of that. I would simply ask them for specifics on their criteria. I always start every meeting the other direction, allow that side to give me their information on their fund. What are they looking for? This helps me focus my presentation, but that will also allow you to see immediately whether there's actually a fit or not a fit, without having to try and discern what their dictionary definition is. So that's the first thing that I would say, relative to that anyway, is how I would attack it. Also, too, one quick comment on hardware, since you brought it up. I've done software, middleware, firmware, hardware in my career. And, a lot of VCs don't like hardware. We've done some, we don't do a ton. There's a good reason why VCs don't like it. And I'll tell you why I do like it. And I think VCs should be more positive towards it. But why a lot of them avoid it is obviously what you mentioned, the cost, right? So there's a lot of cost and a delay to revenue in order to build something. Well, that's the exact benefit as well. Two guys in a garage can recreate any damn software. It's not really that, there's not a big moat around your business. Hardware is hard, but it's also hard to overcome. And it's also from a patent perspective, and we're going through this with several companies right now. And I would, again, I would include this in any pitch around a hardware deal. Usually with hardware, there's some kind of hardware, middleware, firmware. So I mean, software, middleware, firmware, in addition to the hardware, not always. Sometimes that's outsourced to somebody else. But when you think about when you file for patents around that, it's much more difficult to get around a patent that has both a software and hardware component. And my God, if you get into chips and things like that, it's insanely difficult to get around. And we're going to see some really cool disruption in AI, by the way. There's going to be some great lawfare because it ain't just software, baby. And so, but it's very hard to get your way around the patent barriers that you can create with hardware and software in concert. So be sure that you're using that. And, I'm sure you are, but that's something that I think a lot of VCs fail to acknowledge or remember when they're looking at it.
This is such an important point. And again, I'm going back to the public market investing. If you look at, I'm not a big fan of Warren Buffett's personal brand. I think the guy's been a hypocrite throughout his career, but he's a smart freaking investor that did have an information advantage and had access to the best deals out there from an M&A standpoint, from a strategic investment standpoint. But what he always would do is when you look at an annual report, start from the balance sheet. You look at what are the assets they have deployed. And if you look at the things he buys, why he stayed out of technology for so long is there's no assets there. And software is just as Glenn said. You get another smart coder, they can disintermediate. So the competitive advantage of most software companies, and Salesforce took this business model to an extreme, is you raise the cost of switching. You make your software, get people embedded in your software, and they can't switch. Otherwise, it would be disruptive, even though there may be better software tools out there that got introduced. But when you're building balance sheet assets, you've got a long duration asset to monetize over long periods of time. That substantive IP, and especially as Glenn said, where there's hardware involved as well. And that's what Buffett would always buy. Asset-rich companies. And if you look at I could give you a whole history lesson on when corporate America started getting rid of assets, it was due largely to this whole Six Sigma movement. And Jack Welch drove this hard with GE, but you're basically running the business up on the rocks when you do that. When you're getting assets off your balance sheet, you're literally focusing very short-term return metrics at the expense of your competitive advantage. That asset rich companies create that inertia that Glenn was talking about. It's really an important point. And for our startup clients, we're trying to help them lean in on communicating their balance sheet assets, whatever they may be. Because so many investors in startups have adopted the KPIs that have been created around just looking at SaaS business models, software, which is asset light, and those are appropriate metrics because they're income statement metrics. If you can't get to good income statement metrics as a SaaS business model, then you're probably not a good deal. The problem is those same KPIs are being applied almost as ubiquitous KPIs across other non-SaaS business models. And there's investors have been conditioned to ask for metrics that are really irrelevant and even distracting from sound businesses, which is more balance sheet focused. So I guess Michael, I know this is sort of preaching the choir here. You're communicating your balance sheet assets as a de-risking mechanism vis-a-vis where those investors might have already written checks into business models that are asset light, but also far more vulnerable, particularly in times like we're in right now.
So you mentioned assets and Glenn, you mentioned moats. One of the things that, yes, we do have patents, but one of the difficulties that, at least my perception of a difficulty, is the fact that one of our moats is a different understanding of physics. And that seems strange, but the reason we have such a weird looking wing and tail configuration is because it actually fits the physics which most aerodynamicists and aviation engineers don't understand, and they're not taught in school. And so we've actually had an aerodynamicist who designed 7 aircraft in his career that have generated billions of dollars of revenue for his employers. And we had him come in and do a third-party analysis, and he said, I love the design overall, very cool, followed you guys for some years, but I'm really concerned about your manned aircraft, and I hope you don't fly it yet. And I knew where he was going because we had given him access to all of our internal documents so that he could do the independent analysis. And he said, well, the pilot stick force on your control surfaces is going to be above the pilot's ability to control the airplane, especially as you go faster towards your high cruise speed, which for us is over 250 knots. It's turboprop speeds on a piston type engine. And I knew where he was going. And he had actually developed a curve, and he was showing here's what the stick forces are going to be, and your pilot's not going to be able to provide the stick force necessary to control the plane. So as he's giving his analysis to our group, he finishes and says, would you like me to help you redesign the plane so that we can fix this issue that you have? And I said no. And he's like, well, why? I hope you're not going to go fly it. And so I asked the test pilot who was on the line with us, and said, Mr. Test Pilot, when you start to pull back on the stick, when we're doing a high-speed taxi run, before we took off, how much pressure are you feeling on the stick? And it was like a deer in the headlights. He's like, I don't know what you're asking. I said, well, how much do you have to pull back? And he said, I don't know. I can't sense any pressure other than my normal amount of pressure that I would feel on any other plane to pull back, to lift the nose off. I said, how much is that? He says, 2.5 pounds maybe? And yet the aerodynamicist is saying we should be at 55 pounds of back stick force. And he's like, it's not there. And the aerodynamicist is like, well, that doesn't make any sense. You must have given me bad data. And I said, no, what I told you from the beginning was the aerodynamics on this plane are not what you're used to. And
Yeah.
you have to actually look at something differently, and you can't use your traditional tools. He said, we've been using these for 50 years. I've designed 7 planes and they're in production. I said, I know this is not like any of those 7 planes, but I can tell you for a fact that what we're saying is true because we have 4 aircraft that are doing this, and we've proven the physics is different. You have to look at this as a different plane.
You know,
It's not the
this
same.
isn't I had to cut you off. This isn't a pitch session. You can't get into the whole. If there's a question in there, that's one thing.
I
but-
actually,
That's my
I've got a
question.
question
How do
based
you-
on.
Okay.
How do you talk to people when they say, this is just another plane? And yet the moat is the fact that the physics are actually different.
Yeah, or to piggyback on that is like I had an investor say back, he's like, how do I know that this even works? And there's 40 years of research that supports our main thesis and the underlying technology, but the investors are just like, I don't know, man, it sounds like you're just giving me a story.
Yep.
Well, yeah, Glenn, why don't you answer both of those with your numbers of investment?
Thanks, Joe.
Sorry, no.
Well, I think it's sort of funny. I think Bonnie probably, we talk about, we all work on pitch decks and helping founders craft messages, and we all have our own kind of approach. One of the things I often tell founders is that every slide in the deck is basically some form of proof, to kind of go to Joseph's comment. So there's market, like sales proof and credibility proof. Maybe that the credibility could be like the advisors, or it could be the case studies, or it could be the your background, your own personal background or the team's background. It could be those sort of things. Sales proof would be actual revenues or LOIs, or then there's kind of I don't know how I would call it, but like the big brands. Are you partnered with any of the big guys, the big names that are out there that people can kind of latch onto? And there's all these different kinds of proof. And people will say to me, oh, I have to have revenue. Well, no, you don't necessarily have to have revenue. Do you have distribution partners? So you keep going and looking for different ways to apply layers, like an onion, layers of proof. And you're just trying to get the VC over the threshold of trust. So some of that's authenticity, but a lot of that is just to Joe's point of looking at a balance sheet, looking at the basics, like how many layers can you apply that VC, and Joe's unique in that he's really looking at fundamentals. To be blunt, a lot of VCs are pattern matching, gut,
And
Joe and I are aligned on this one.
Oh, yeah. And that therein lies the challenge for entrepreneurs, right? Because virtually the signals that, again, we're talking about early stage, there are really good smart VCs and even smaller number of good VC firms. But the majority of early stage investors will largely are pattern match, and the principal pattern that they have looked to is who else is in the deal. That has been the principal pattern.
And I know you and I have talked about this, Joe. They like the founder did something before, they they were referred by somebody they like, they worked at the same, there's always some connection, there's a bias in there somewhere.
Right. And at the end of the day, it's social capital and subjective signals that define why people write checks in this asset class. And that's literally the challenge that I've been trying to tackle, is how can we migrate the very decision-making process to apply the lessons learned in the public market investing, to manage those biases and those inefficiencies, to deploy capital with more efficacy, efficiency, and effectiveness, i.e. risk-adjusted returns. That is the core issue, because we keep repeating the same problems. These same conversations I heard 25 years ago, and we're having them yet again. We're repeating the same patterns that the outcomes are highly predictable. And again, the impact on entrepreneurs themselves is the real tragedy, because the VCs have no downside. They literally have a great gig if they can launch a fund, if they're good salespeople and can launch a fund, they've got a good gig. because it's not their money. And they get to basically have an asymmetric upside without any of the downside. They get a management fee and they spend the money. And if it doesn't work, oops, that's what happens. We didn't grab a unicorn because, and they make an excuse, but we were in all these deals with all these top tier VCs. So it's not our fault. Right? This is the same pattern I've seen time and time now, 3 generations of VCs.
Now, to that point, Joe, I can't solve, you and I and Bonnie, we can't solve the problem of, you know, unless I refer you to another fund, I can't solve the problem of, you know, do they know the founder? Do they like the founder? Like, I can't solve that. So for those scenarios where you can't solve that problem, the best solution I found is what I was talking about. So make every slide, ask yourself when you look at every slide, first question is, why is it in here? But really it's, what is this proving? What is this proving out? And to yours, you know, Michael, it's tough. You're in a tough spot. I mean, I think you've got the same, you know, I always talk about the hero's journey, the hero's arc, whatever. That's the story you often use in a pitch deck, right? And the story you're telling is the same story that almost every innovative founder has to deal with. The difference is you're in an old, which is kind of near and dear to my heart, because Quake focuses on old line areas, infrastructure, transportation, logistics, manufacturing, robotics. Like we play in old industries. The problem with old industries is they're resistant to what you just described. So you're dealing with the exact same problem that every startup founder in any innovative space has to deal with, but you've got the added complexity of trying to move an older mainline industry out of its existing ways of thinking. The best way I can say to get to that is just layers of proof. And again, it's not, I don't, without spending serious time directly, I couldn't give you better advice than that, but that's where I'd start.
Yeah, layers of proof and address it right at the top, at the onset of the deck. You just hit them, the questions that they're going to just hit it right at the onset.
Yeah. There's no benefit in investing in a plane that already exists. Okay. That's the whole point of innovation, right? There's no, you know, Joe used the term, I think earlier, binary impact. There is no upside to investing in tried and true.
Yeah.
You're not a venture. I'm sorry. That's not the game we're in.
Yeah. That's incremental innovation in a business model. And unless that's really meaningful innovation, it's not worth bothering. But again, I'm guessing 2/3 roughly of startups that get funded are incremental innovation based on what they're claiming they're doing, but it's really not material innovation. It's not real.
Yeah, it's derivative
stuff. Yeah, it's a derivative, exactly. And it's oftentimes access to marketplaces, or they've got unique access to customers. Well, that could be true, but it's hard to build a business if that's your principal advantage, because once that customer has been satiated, who's the next customer? Who's the next customer? And anyway, been going for hours.
No, and I do love businesses, though, as an aside, for those founders out there, I love taking a tried and true technology that's innovative in one space to an industry that never thought about it.
Yeah,
I see a lot of people talk about it like that's derivative. It's not derivative. I made billions of dollars doing that, guys. That is not a derivative thing. That can be massively innovative done right, and it's a de-risk model too.
Yep. And again, I wish we could create even more conflict between Glenn and I, but I guess the older you get, the longer you've been around, some of those observations are converge. But yeah, I agree completely with them. That is the innovation, because there's the nature of people getting anchored. This is behavioral economics, but people get anchored in their perspective. And that's why typically existing constituents aren't part of what's next in an industry. It's that disruption cycle. Clayton Christensen has identified it very clearly. But the innovator's dilemma, this challenge of the actual real innovators, is, can you build a business and survive and monetize that which you are bringing innovation to? Or is it the people that are going to pick up the pieces and have less capital at risk, and you're basically educating the market of the need for this, and then somebody else is going to actually monetize innovation? That's what happens a lot as well. It's just the challenge. You know, at one time there were 300 automobile manufacturers in the United States. 300 automobile manufacturers in the United States. Think about that. Holy cow.
And then there's the other side of it was when cell phones first appeared, you know, you had one tower, well, it was pretty limited. Then you had a second tower. It really didn't really hit the zeitgeist and really gain traction until you had cell towers all over the place. And it was something you could actually use.
You needed infrastructure, yeah. And you could store your music on your phone. God bless Steve Jobs, right?
Yep.
That's ultimately what drove it. So
yes.
Anyway, this is all good stuff.
Oh, somebody in the chat wants to know about about your impact fund. Your what the focus is, the Dubai Impact Fund.
Yeah, so it's a broad impact fund. So it covers a range from I think some of the obvious topics people are focused on are like renewables, carbon, climate. So there's a big planetary focus, but it also has a big human healthcare focus as well. So I think a lot of times when people think about impact, they fail to think about the human condition. So that can be, by the way, that can be financial, poverty, things like that, but it can also be health in raising the, improving the quality of life across the planet. That's an area of focus. We've already identified, I think, our first 4 or 5 investments. They range from, we've got an incredible, and by the way, I should note this, I'm kind of the resident cynic, which isn't to say I don't love impact or I don't like the environment. It basically means that this is why Joe and I probably get along, is that I tend to be like, I don't give a crap what your story is. I really don't care. I mean, I'm a fiduciary. I think that probably Joe, that having run public companies, having 25,000 shareholders and having 40 analysts that were kicking the crap out of me that probably sounded a lot like you, battered me into shape. But I have a very strong view about being a fiduciary. When I'm running a fund, I'm working for people and there's a yield. And I expect that for people managing my money, and I expect it if I'm managing somebody else's money. So when they asked me to be a partner, I was like, you're going to have a bar here, a higher bar than you thought. So I'm the cynic who basically comes in and says, well, that's a really cool idea that's never going to work. That's a lot of what I do. And I don't want to sound like that guy, because I'm an operator and an entrepreneur. So I'm a generally positive person. But the other thing I would say I'm a cynic about, and I want to be clear on this. I think if you're going to do things around impact, you have a higher obligation, not just to make money. Don't get me wrong here, though. I think if your focus is to improve the world, then the worst thing you can do is take money out of the ecosystem and blow it. You need to take money in the ecosystem, build it, and roll it back in. And I was involved, for those that may have touched on this, again, in the aviation, you might have touched on it. There's some amazing technology. 20 years ago, I was involved in fuel cells as an investor and advisor. And there's some remarkable technology, but there was so much damn snake oil in that space that we set that sector back about 15 to 20 years. Because we burned so much capital on crappy ideas. There are some amazing things. I can tell you right now, there are some just absolutely, I can remember 20 years ago, we built a motorcycle that drove from the Bay Area to Sturgis without a recharge. Oh. And I don't know if y'all know how far that is, but that's a trek. And that was 20 years ago. There's just some we were building micro drones that could do just some remarkable things. And none of this technology has moved because we destroyed the ecosystem. So if you're going to do something around impact, do it right. And so that's, maybe that's not the answer somebody's looking for, but that's what my role in this Dubai pace, and it's Sustainable Impact Partners is the name of the fund. And my role in that is to kind of be the eye of Sauron and come in and say,
Is that a Hobbit or Harry Potter reference? I mean,
that was a little bit of a little Tolkien reference.
Yeah. Lord of the Rings.
None of which I've read. So, but I guess from the label.
Good for you, Joe.
I got it, loved it.
Look at, again, having been a fiduciary, literally a professional fiduciary. And if Glenn was in the management of a public company, yes, he was also a fiduciary. This is 99% of the VCs out there can't even spell fiduciary, much less understand what the hell it means. in their role running and investing somebody else's money. This is the great crime of the venture industry. It's not been professionalized and had any remote applications or expectations of a fiduciary behavior. This is the root cause of entrepreneurs' frustration. And that is a major step of what needs to be fixed. Because if the capital were allocated, if you look back over time, Glenn, if the capital were allocated properly, these people actually knew what they were doing, you wouldn't have systems destroyed like this.
No.
You wouldn't have this stuff. You would have iterated. You would have deployed capital in an iterative fashion versus this FOMO overfund. I mean, this is what cost Kleiner Perkins their premium brand as a VC firm. When John Doerr got so excited over green tech and solar back, and they overfunded, and he hyped everything from Segway to everything else, blew up the firm, and it literally set back the green tech industry, alternative energy industry, because of bad investor behavior. And this is, again, the sort of things I've observed for a very long time. And we can't afford to keep repeating the same patterns and the same behavior. You know, China, Israel, there's other countries kicking our ass now and actually funding deep tech that wouldn't blink about writing a check for what Michael's doing. And the Middle East is getting interesting.
Well, and that's exactly what's happening in aviation is we're seeing billions of dollars flow into designs that have been, discussed for years and have never been successful. Blended wing bodies, transonic, truss brace wings. I mean, you go down the list and they're all bogus. They've all been tried and they don't work, or they don't work well enough that there's much juice in it, but they keep squeezing. And this is the only thing that's really been new in the last 50 years. And yet people don't understand it, so they don't invest. But we're getting some traction.
I want to mention the part that the tech press plays in all this. These big investors put a lot of money in, they're sucking out all the air because the tech press they aren't real reporters anymore. They don't do their diligence. They don't investigate anything. They just blow their horns.
And all these ecosystems too are connected. I think this is an important, as an entrepreneur, I'm always not even as a venture capitalist, but particularly as an entrepreneur, I was always looking to see what the impact of one growth area was going to have on another. It's kind of the old joke, don't invest in the gold mines and invest in the picks and shovels, right? Well, right now, everybody's throwing money at AI, and I do think a lot of it's really stupid. I think that first of all, Dartmouth coined the phrase in '56. It's been around certainly since 1960 in a substantive way. I've told you before, Bonnie, Joe as well, we're really into an age of accessibility as opposed to it's not anything new, it's more accessible. However, because it's more accessible, there's some interesting things happening. And speaking to impact, massive energy consumption. Okay, I'm trying to leave politics out of this, but electric cars, okay, and the desires around electric cars, coupled with the current and growing usage of AI, if you guys look into that, Google what it uses, we're talking something in the neighborhood, if I recall correctly, I think it's about 30,000 households a day. Is that right? I might be off on this. I'll have to go look it up, but Google this after the call. I had looked at this a while back. It's a ridiculous number of households consumed per day just for OpenAI. Okay, not for all of the different systems, just Google OpenAI. Now, as that accessibility expands, we're going to be putting so many households effectively on the grid. We don't have anywhere remotely close to the capacity for where AI is going. Then add to that electric vehicles. So forget about impact and renewable and clean energy, just energy.
Just energy. Well, think of Bitcoin data mining. That's a big energy suck as well. And those are two areas that are expanding exponentially until they reach the laws of physics, which are not that far out of just sheer limits due to the available energy.
So when you see a blind spot, I guess my reason for bringing that up, though, it's sort of fascinating when we're thinking about an impact fund, everybody's they're kind of myopically focused. And I'm like, look, there's this big looming disaster. We can call it whatever the heck we want to call it. There's a looming problem. And we're building this, we happen to be building this impact fund. Maybe we ought to be looking at some things in this area because there's going to be big market need. So I think even though that may not seem like its impact is going to be energy, not just clean energy. And that's not a discussion anybody really wants to have, but it's going to be a really big discussion in about 5 years.
Well, AI also has capacity constraints on just sheer volume and availability of chips, and there's some real structural limitations. So,
well,
yeah.
Now I don't want to waste time, Bonnie. I want to be careful here on time, but I do want to say, like, we're looking at probably the coolest, and I've looked at least 1,000, probably the coolest carbon capture deal I've seen came out of Caltech down in Southern California. It's a phenomenal company, but they use filtration. And you think to yourself, okay, filtration, there's some filters involved, some coating. And you think, well, no big deal there. It's the same coating used on microchips that are predominantly being used in AI right now. So there's a massive conflict between supply logistics right now between a lot of these industries as well. And that's another area where if you're looking, again, as an entrepreneur and investor, you can make some really interesting, there's a lot of opportunity. I don't want to call it arbitrage, but there's a lot of opportunity, deviation. I don't know how to describe that. But
Arbitrage is the right word. Yeah.
You didn't even mention all the power that the crypto miners are sucking out too.
Well, I did a lot of that for those, I think you guys knew I was in that. I did so my family has oil wells and we have rice farms, 100,000 acres. So if you got rice farms in Texas, you got oil wells, and we had flare gas coming off the wells. And so we had free energy and we were doing mining off that. And so it made sense even when the prices weren't particularly good, but now that they're where they are, it's to Joe's point, I'd forgotten they've moved so far up again and people are mining like crazy again.
Yep.
I know we're over time. This is a great conversation. I have to have you guys back again soon.
Always fun.
It's always fantastic. Does anybody have one last quick question? Or
Yeah, well, I had a quick one for both of you about this entrepreneurial theater. Shows like Collision and Web Summit. They're having one in Toronto. They're charging startups $1,000 to attend this thing. And I've been to Collision in Vegas. Like, you go there, you can't. Like, it doesn't seem to be very productive use of time, and it's very expensive for the startups. What do you think of all this entrepreneurial theatrical activity?
I think it's a root problem in the structural components of the system. It's
not a fan. Not a fan.
It's a problem. It's a structural problem.
Aren't
I want to be careful because I know there's some people who are probably pro that. I want to be careful. So if they can be a monster time suck and capital suck, right? But I think if you go and handle them properly and do a limited number of these, if you plan in advance, if you have coordinated meetings that you set up in advance and you go there with an agenda and meetings, they can be very effective. If you go to walk a show, if you go there to get meetings on the fly, that's an utter waste of almost never works. I have seen some really interesting guerrilla techniques that have worked in the past, but I'm generally pretty negative about that. The other thing is, I think you want to be very careful as a founder. Again, we've got about 280 investments, 600 founders, and we have seen, and I personally have seen this in my career, the founder, what I call business famous, where you start to become enamored with your own reputation. Now, I'm not suggesting for the PR folks out there that there's not value in being a leading voice or anything. That's not what I'm talking about. I'm talking about when the founder starts to be more excited about their accolades than their business accomplishments, their actual progress. And they start, they like going to being on the panel, like that becomes the focus, not because it's driving business, but because they like being business famous. And so I think that's the other side of that coin that I would just mention is to be cautious of. But no, I'm with Joe. I don't like them.
Look at it. There's no better example of that than South by, which is going on right now. And the ROI, when you look at the colossal waste of time and money, crap littered all over Austin from all the flyers and the handouts, people shouting at the top of their metaphorical lungs and voices, trying to get attention amongst all this noise. And it's a big party where the marketing and the event planning people make out, and the restaurants and the bars make out. But from an ROI of an entrepreneur's time and financial commitment, it's not great. And that's just that's just an extreme version of demo days and everything else, because you're literally trying to create something that's out of thin air that is also highly ephemeral and has a very low ROI unless you get lucky.
You could say the same thing about the PDAC mining show in Toronto, which just concluded a week ago. I mean, all those companies that are spending all that money just to be there are just there to try and get investments, and people walk the show. I don't know what the ROI is on big shows like that. I honestly don't.
You know, I wanted to mention that we had a friend of mine who was a founder. He spoke a couple of years back in person. And there were 3 conferences going on at the same time, you know, one big one in Vegas and a big one in New York and a very small one in Florida. So, you know, he wanted his team to enjoy New York and Vegas. So he sent them there and blah, blah, blah. And he went to this little show in Florida. He said, "Ah, this looks interesting." I was like in one little room in a hotel. Then he had this little table. And that's when Amazon came. You know, they don't want big shows. They want nice, something a little more civilized. And that's when Amazon came by his table and ended up acquiring his company, and which he named after his sister. They never even changed the name, and it's his technology is still called Alexa. And it was, and the whole thing, well, of course, it was finalized later, but happened at this tiny little show in one little room in Florida.
Yeah. The hype cycle, again, this is where I get a little bit too professorial, but if you really unpack the why bad behavior happens, and I'm thinking of investment or behavior and entrepreneurial behavior in this context, it is this limbic brain and the attempts at manipulating others' limbic brain around getting out of them what you want. An investment, a consumer transaction, that manipulation process, and for entrepreneurs to lean in on that and unfortunately, it's the only effective way for them to oftentimes get attention, unless they have in-network connections and can create their lead VC can create some degree of FOMO. But it's still optics, and it all resides in the limbic brain, and that is the problem. You know, it goes back to behavioral finance, behavioral economics. If you want to solve something, you have to get the root cause and then look to how to address those root causes, and that is the root cause. It's unfortunately what all entrepreneurs largely have, unless you've got a very unique situation with access to all the right people and they have all connections to all the right people, and you get a much easier path. It's called path-dependent success. But there's a book out. Somebody wrote about this. I haven't read it yet, haven't even ordered it yet, but I saw a podcast of the author interview, and it was exactly these topics. And it's called Fluke. That's the name of the
book. I saw that book. Yeah.
How much of success, and not just talking about entrepreneurial success. They did talk about the venture industry in this podcast and entrepreneurial success in general, or specifically. But when you look through history, how much of the outcomes are based on a great deal of randomness versus somebody actually orchestrating a success path because they did all the right things. And there are circumstances where success is path dependent, circumstances dependent, and very unique situations. But largely, so much of life's outcomes, history's outcomes are random. So with that in mind, if that's a fact, how do you manage randomness in the process of entrepreneurial success, either as an entrepreneur or as an investor in entrepreneurs? That is the core issue.
On that note, I'm wondering what you guys are seeing, or whether you're investing or researching the Neuralink, the companies that get into your brain and figure out all of these from a non-emotional standpoint.
Yeah, we've made a couple investments in the area. It's really early days still. Obviously Elon's talking a lot, but I think in terms of what we're focused on is more improving efficiency or optimizing basically brain output, as opposed to we had made some early investments in controlling machines with the brain, and we actually had some companies that were making pretty good progress in that. But it is a limited use case challenge right now. So there's a, you know, and if you're looking at a fund with a 7-year, 8-year time horizon, maybe one, I don't know, for people who maybe don't know how fund operates, you know, we've got basically 10 years to get our shit together. Okay. And so when you look at a lot of those that are actually controlling machines with the mind, that's a very difficult, if you're going to be an early stage fund like us, it was difficult. So we're not doing a lot of that anymore. Now we're focused on, you know, again, output, efficiency, optimization, almost meditative. So we've got a company called Neurosity we invested in that has a device called the Crown, which is a really interesting device that dramatically improves your output over the course. You know, you use the device for about 15 minutes, your output for the next 3 hours is substantially increased. And
is this the neural mapping technology? That's really cool stuff, where they can literally tweak your brain through doing what's called neural mapping. It's absolutely brilliant, and it's highly effective. And if that cost curve came down, that would be really cool.
That's the challenge right now, is the and it's, you know, some of that's a function of scale, and some of that's a kind of a little bit more of a hard cost problem. So we do need to see those costs come down dramatically, probably like 80%.
Which they will eventually. It happens.
I don't have that kind of time. So I guess the short answer is we're not doing a lot of it, just because the timing for us is tough. But if it was an A or B round fund, I'd do a lot more of it.
Against that backdrop, sorry, I know we're going over, but something like that, it super quick. Something like that is perfect for military, has military application, so dual use, perhaps. How do you feel about working with the government and especially
I did
for
a lot of it.
startups?
I did a lot of it. And so actually I'm fairly negative on it for startups, but so I had a board at one point, one of my public companies, I mentioned the biometric company. So my board we had Asa Hutchinson, who was the head of TSA. We had 2 former heads at NSA. We had Tom Ridges, chief of staff from DHS, Salufo, who's head of cybersecurity for Bush. So we were doing like way deep, heavy, like the Supreme Court computer system. We know who the leaker is. I guarantee you, we know who the leaker is. Because we secured that computer system, and I know what it would take to spoof it. So I have a long history selling to the government, but it's a really long sales cycle. We're about to run into a turnover, which is always frustrating. So if you're doing like a procurement process, that's a multi-year procurement, you go through the pilots, you finally get through the damn pilots, then you have an election, then they swap out all the cabinets, and then suddenly you have to start the damn procurement over. And so it's really a challenge for an early stage team. Plus, you're never a prime contractor, you're always a subcontractor. So there are pockets of attack that I'm very, very fond of. But it is very hard, you know. So there's a series of things you have to do and I'm talking predominantly US government, right? So we've got actually a lot of startups who are selling into international governments because it's actually quicker, easier than it is selling in the US government. US government, you're generally going to be a sub on a prime contract. You're going to be screwed over by the prime contractors, Booz Allen, Accenture, Unisys, Northrop, Lockheed, etc. You're going to get screwed over unless you can be on every prime's sub team. The next thing is you want to try and get on a GSA schedule. So you want to be basically in a situation where the government can buy you without having to go through the process of adding your numbers and all that to the cage, basically, so they don't have to put a SKU on your stuff, for those that kind of know how retail works. So you already, it's like if you want to sell into Walgreens, it's a lot easier if you're already in Walgreens, you can bring a new product into Walgreens. Same thing is true with the government. If you're in the government, you're on a GSA schedule, much easier for them to buy your product. So for a startup, those are really expensive challenges. I mean, it takes time, energy, money, lobbyists to navigate all of those things I just described. So to answer your question, if you have the right product, that can go into particularly Joint Special Operations Command, Special Forces, then we're pretty bullish on it because those groups can move very quickly. If you've got a product that can go into an existing procurement, so there's already an RFP, there's already a request for proposal, already a selection made. There's already the criteria are already established, and you can roll into an existing contract through somebody who already has a relationship, then that's positive to us. If, on the other hand, you're going to try and go and create a market from whole cloth into the government, our view on that is about 3 years. So that's my 2 cents there. I mean, and I could give you a lot more detail if you want to dig into that. I got a ton of background selling into the government.
Amazing. Thank you. Yeah, super.
Yeah, I know that we've gone way over time, and I could do this forever. I'm going to invite you guys back again in May. We'll pick a time if you don't mind.
Can I make one quick plug? It has nothing. I don't make any money off it.
Absolutely.
It's nothing for me. It's for everybody else. Somebody mentioned they like books. What I would recommend to anybody on this call, whether you're a VC, a banker, an investor, or what, founder, you like to consume business books, get a service. So I've used for 25 years SoundView book summaries. It's old, it's tired. I mean, there's lots of them out there now. They're not the best necessarily, but it's one. So you can go Google SoundView book summaries. They'll take all these business books that are put out, they'll publish 10 to 15 page summaries for all of them. And you can get any of them if you're a subscriber. I'll usually download 10, 15 of those a month, read through them, and then I'll buy 2 or 3 business books based on the summary to dig in deep. A lot of books you can consume bulk of the value off the summary anyway, but there are some that are really just so great. You're like, okay, I really need to own that. That's what I would recommend to those of you that do like to read and want to pick up, and especially as I get older and it's a diminishing skill. That's a tool I've used for 25 years really effectively. I'd encourage anybody, whether it's that brand, which I happen to know, or one of the 6 or 7 others that are out there.
What's it? SoundView?
SoundView book summaries. And I think the domain is summaries.com.
Oh.
I don't know why the hell they're SoundView.
Okay.
They should talk to one of you branding people.
Well, as I recall, they started out with audio, and I actually have a bunch of their old audio book CDs. They used to publish them on CD.
That's hilarious. Yeah, I didn't, and I've had them for ages and I didn't know that. But some of the best books that I've come across, I found originally there. Sorry, Bonnie. That came up earlier and I just wanted to mention that because I thought that could be value for somebody.
Yeah. Thanks for
Oh,
that.
thank you. I know we have to go. Joseph has to go. So
Yeah,
I'm going to have you guys back very, very soon. Your schedule is permitting it. Now we run this part of all these funds. Thank you so much. And thank you everybody for being here.
All right. Take care, everyone.
For hanging out this long, folks. Hope it was worth the time.
It was
a great discussion.
Thank you.
It's always fun.
How do we
Thanks, Warren. It's always a treat.
how do we come back? How do we come back to this meeting? Are we allowed to come back? I'm a visitor.
Oh, sign up for the newsletter. We always post them. I told you what I posted it in the chat.
Okay, yeah, I saw that. Is this a group that you have to join? Is it
No. It's free. No, anybody, as long as you get in before Eventbrite cuts us off. No, we do them every 2 weeks.
Every 2 weeks at this time?
Yep.
Okay, and you have like different speakers every 2 weeks? Is that the idea?
Different.
Okay,
Yes.
no, it was a fascinating conversation. Great speakers. I thank you for allowing me to be here. And as I said earlier, as a guest, I'd love to have a meeting with everybody. My calendar link is in the chat if you want to save the chat.
Hey, speaking of which, Bonnie, can somebody share that? I didn't get to go through the chat as it was happening. I apologize for that. I was behind a little bit there, but is it possible to get the chat transcript, or do I need to just copy that real quick?
Oh, you can copy it, or I'll send you the copy of the recording.
Okay, that'd be great. Awesome.
Okay, I'll send you the recording.
Okay, thanks, Bonnie.
Thanks, guys.
Oh,
Thank
wait,
you.
Let me
ciao.
let me save the chat first before you go.
Okay.
Okay, I got it. Thank you.
You got it? Okay. Bye.